Joining us now is Jay Morelock, an economist with FTN Financial, who will discuss this and the other economic news of the day. Jay, welcome back to Arise Xchange. Always good to see you.
Good to be here.
Let's start with the markets. The markets tanked today because, well, this is what the analysts out there, sort of the Monday morning quarterbacks, are saying because of a stronger dollar. Can you walk us through the connection between a stronger dollar and the markets?
Absolutely. So a lot of this has to do with discounting future cash flows. So it's the anticipation of future cash and what they're going to be worth. And if the Fed is going to raise interest rates, that's going to strengthen the dollar. A lot of money is going to come in, flood into the U.S. market, and that discount rate becomes higher. And as you discount to the present value, current asset values actually become lower. So as interest rates go up, present value goes down, and stocks on the broad can be seen as a large asset value. So if anticipation for future rates is up, that's going to fall.
And you factor in the currency conversion for international companies, they take a little bit of a hit on the top line earnings.
Absolutely. And we've seen that actually reflected. You mentioned durable goods before. I think there was some stabilization. There was a lot of worry that this was really going to tank due to the strong dollar and that currency conversion, both for local manufacturers, but that also helps, foreign, especially what we see in the Eurozone right now.
Okay, let's look at home prices for a moment. And we've done this story last week. We did it several days. Every day is a different data point regarding homes. When you look at it in a totality, are you confident that we're seeing an improving housing market, or is it being driven by the fact that people are worried that interest rates are going up and they're still looking after cheap money?
It's a combination of both. I think housing prices have, increased in a sustainable fashion, given the fact that we have about 2% income increases regularly, going back to about 2009. The key factor here is that interest rates, long-term interest rates, the 30-year mortgages, have continued to fall. So house prices can exceed income growth only in so much as long-term rates are falling.
So because we're getting wage increase of what you said, about 2%.
About 2%.
And interest rates are about 3.5%?
Yep, we're down to about 3.5%, and home prices are actually growing around 5, 6, 7% a year. That mechanism only works as long as long-term interest rates are falling.
That sounds like a little bit of a scary formula, though, because we've seen at any time mortgage rates start to inch up a little bit, the housing market gets really spooked by that, which doesn't sound like a really strong foundation, if you will, to work off of.
You're absolutely right, and that's the rub. So if interest rates move up, housing prices must come down unless we see a correlating increase in income. So
if you were the Fed, what scares you the most? Raising interest rates, they say they don't pay attention to the stock market. We know that's nonsense.
They do, yes.
What scares the most? That the raising interest rates are going to spook the market or spook the housing market, which in many cases really impacts the average American the most because of what we call the wealth effect.
You're absolutely right. And it's that effect on inflation, too. So a lot of this does come back to the housing market. About 33% of the core of our inflation measure that we use to gauge is related to housing. So if housing falls, we've already seen goods prices have been falling, a lot of service prices have been falling. If housing joins the party, we're actually going to see more disinflationary forces, and I think that absolutely concerns the Fed, and that's really one of their biggest inhibitors to raising rates right now.
Okay, and looking at the GDP, what are you thinking for the economy for going into this quarter and going into next quarter? We had a possibly negative first quarter. We may get a negative second quarter, even though now apparently the GDP numbers are all kind of messed up from the government. Nobody knows what the numbers are, which maybe is a good thing.
Right, exactly. Now that we're on our second seasonal adjustment, where are we? It's a good question. I think the first quarter will be revised negative, and I think it should be negative. I think the impact of the strong dollar, oil prices falling the way that they did, that's going to hit hard in the first quarter. I think we rebound slightly in the second quarter. I see about 1% in the second quarter. I think third quarter we see a bigger boost if, and this is a big if, the dollar firms up and oil prices remain where they are.
The dollar strengthens?
Excuse me, just stabilizes.
Stabilizes, and oil prices don't rise.
Exactly. Or even if they rise, that's fine because it can impact the shale.
In oil, by
right,
the way.
and we've been fine. That actually helps us. I think the big confusion where we saw the analysis that lower oil prices are going to stimulate the consumer. In most cases, that's true, but the shale boom has been one of the biggest contributors to our post-recession recovery. So that, because we're not in a normal business cycle, takes a big hit.
And we have to remember, if that comes down, then the numbers get into the wages, don't grow as much, the employment numbers look different, so it's an interesting point. Jay Morelock, thank you as always.
Thanks for having me.